We're going to kick things off with our first panel of the day, Financing Innovation and Economic Growth. Innovation and entrepreneurship are at the core of human existence, but I believe what has transformed the process of innovation and entrepreneurship is financing. Our first panel will discuss the process of financing for the entrepreneurial endeavors in our economy. My colleague, Dr. Steph Miller, will moderate this panel. He is a senior scholar with the Financial Markets Working Group at the Mercator Center at George Mason University. He is also an embodiment of the bridge between academia and policy world. He is a product of George Mason University. He got his PhD from George Mason University, and after that he was a professor at Bryn Mawr College and also at Monash University in Australia. He's been an economist at the World Bank for a number of years as well, and he's back at the Mercator Center doing lots of good policy work. Please help me in welcoming Steph and his first group of panelists. Thank you.
So thanks, Ben. I taught financial economics for about 7 years. And when I did, I would always start the semester by giving students the big picture of what financial markets are all about. And I'd start with the two basic functions. There are different ways to classify the financial system, but it was basically how can we transfer resources from those who have them to those who want them, and at what price? And when I talk about resource transfer, I'm thinking both for settling payments for goods and services, but also for investment, which is really the topic of today's panel. And the second role of finance was how can we transfer risk from those who don't want it to those who do, and again, for a price. Now, of course, lately we've heard a lot of discussions both in academia, in the media, in politicians as well. They ask the question, is there too much finance? And that's a very valid question, but I think it also distracts from the important fact that finance is about transferring resources and risk. And also, that helps facilitate economic growth. So to get into more of the details about that, we have on our panel, I guess I'll start. We have Brian Knight, Associate Director of Financial Policy for the Center for Financial Markets at the Milken Institute. He'll give us an insight about how small and mid-sized firms finance themselves, and also about how finance and technology work together and how that will change the way we do things. We also have Jamie Brown, the Iowa Bankers Faculty Fellowship Associate Professor of Finance at Iowa State University, and he does some very important research on how the method of finance translates into the type of growth that we see. So he'll share his perspectives on that. We also have Ray Keating, Chief Economist at the Small Business and Entrepreneurship Council, and he'll give us his perspective on how small businesses use finance. And then lastly, we have Tom Miller, the Jack R. Lee Chair of Financial Institutions and Consumer Finance at Mississippi State University. He does research primarily on consumer credit and options, futures, other derivatives. So he can shed light on how that risk transfer role helps in the financing of growth. So let me start by throwing out this question to each of you. From either your research or your experience, can you explain how finance fosters growth? And I guess I'll start with you, Brian.
Sure. So, I mean, finance in many respects is essential for growth. Yeah. An entrepreneur may not have sufficient assets immediately at hand to build their business, and they're going to need to reach from outside. Another thing I think we should think about in the importance of finance is one of the big innovations and one of the importances of the corporate form is that it helps shield people from personal liability. But if you can't access outside capital, if all of your finances are one-to-one tied with your venture, and it fails, you have complete personal life. You've lost all your money anyway. So the ability to access outside funding is absolutely vital to letting people get businesses off the ground.
Jamie, how about?
Well, sure. I think that's a really nice perspective for thinking about why finance matters from an academic perspective. It may seem obvious that finance is important for growth, important for investment, but actually pinning down how important finance is and whether finance is really a hurdle to growth is a much bigger challenge than you might think. And so, from my perspective, the most compelling evidence that we see on the importance of finance is not just looking broadly and seeing that well-developed economies also have well-developed financial markets, because these, it's hard to know what's leading what. The most compelling evidence is that well-developed financial markets matter relatively more in certain sectors and for certain kinds of companies. I mean, a large company that generates a lot of internal cash flow, they're going to be able to make investments whether or not there's a lot of arm's length financing or external financing that's available. Some sectors don't need a whole lot of external financing. So when you look across countries and when you look at within countries over time, there's really strong evidence that improvements in access to external capital, better financial markets, matter disproportionately more for some kind investment, productivity growth, new firm creation in some types of sectors and some types of companies than others, namely the kinds that need external financing. And I think that's sort of that intersection is what you have to focus on if you really want to understand the mechanisms linking finance and growth.
Thanks. Ray.
Bringing a small business perspective to the table here, our members, we have about 100,000 members across the nation, and beyond, one of the biggest challenges they will often talk about is having access to capital. So it can be a tremendous, it is a tremendous challenge for many, many small businesses. So that's why when we, for example, talk about public policy issues, and one of the great things about representing small businesses is that no matter which side of the aisle, everybody loves small business. That's what they say. But when you get to the financial side of things, we have to make clear that when you impose costs and policies on investors and on lenders, banks, et cetera, that matters a lot to small businesses in a huge way. So that's part of the challenge that we have because of the vital importance of financing to small businesses and the tremendous challenge they have that we don't want to see additional costs and burdens put on the people that supply those funds.
Okay, thanks. Tom, why don't you?
Well, let's look at an area of finance that appeals to everybody in this room. You all have an education, and imagine if you had to save for that education before you bought it. Kind of like the old Henry Ford model of financing cars. It was on a layaway plan. He said, what will you do is you give me money until you've got enough, and then I'll send you a car. Well, gee, Henry, we kind of like to drive the car while we are financing it. But if you have to work a menial job to save up for your education, and you can't grow those funds because there's no financial system to pay interest on them, and the price is going up over time, you think, gee, how in the world can I get ahead in my education? So in my lifetime, student loans have become very important. And you've had access to capital markets to finance your own investment in human capital, and you probably don't even think about that. But that is something that is really important to all of us because you become we hope, a productive member of society and a taxpayer and a good citizen and what have you. But so I think that's where, on a personal level, finance hits us all.
Thanks. And just briefly, before we go on to the next, or change course a little bit, do you see any change or given that there's technological change and how that's affecting the financial sector, do you see the relationship between finance and growth changing going down the road? Just if anyone wants to chime in on that.
Do you mean in terms of business, when businesses access capital and when they need financing?
Yes, right.
I mean, I think it depends a lot on the type of business. I mean, there's a lot of discussion now about how you can launch a smartphone app for next to nothing, and there's some truth to that, in that you can build the app for relatively cheap, particularly if one of your partners is a coder, but that you need money to scale. I mean, so that's a challenge. And then for businesses that have capital requirements, you do need the money to access the machinery or the rental space or whatever you need earlier. So technology may be shifting the need for finance later in a company's life cycle for certain companies, but for other companies, they're going to need capital early on anyway.
I think also from the technology standpoint, what is technology opening up in terms of additional financing sources or access to it, obviously? So we heard crowdfunding earlier, peer-to-peer lending, just being able to access more financial institutions when you go online in terms of doing a loan application. All of those things are a huge plus from a small business perspective, certainly from a technology standpoint.
Yeah, I don't think it's going to change the connection between finance and growth at all. But technological innovation, financial innovation may allow us to finance stuff we couldn't finance before. Yeah. And this gets back to the point about if you want to understand why finance matters, I think that's what you got to focus on. Yeah. What are we financing? What are we doing that we would not otherwise be able to do? Yeah. And financial innovation should assist with that.
Let me just piggyback on that a little bit and say that whenever you have new ideas that are going to grow a new business or a new economy, the financial system has to keep up with that in innovation as well. Mm-hmm. Because we just can't keep doing things the old way and hope to foster growth. Mm-hmm. So as businesses, new ideas show up, new technologies, the finance system just will keep up.
All right, so let me change focus and get more into the black box, inside the black box of how finance relates to growth. And I'll ask, can you speak of how finance fosters or sparks innovation?
I mean, you mean innovation among companies? Or
yes, within the companies.
Yeah, so I mean, as was mentioned, new ideas are going to need some seed capital. You're going to need somebody or a group of people who are willing to take on the risk of that new idea and that innovation in order to fund it and have it succeed. And as was mentioned, technology is allowing us to sort of broaden that base where crowdfunding, broadly defined, marketplace lending, the ability to utilize things like the internet for communications has the potential to dramatically both expand the investor base, shorten the communication chain, and more finely spread out the risk earlier in a company's history. So unlike, say, a public company which can, has a public float and can sell its risk to the general population, technology may make it feasible for smaller, more innovative companies earlier in their lives to leverage that same sort of thing.
Yeah, to piggyback on that, the angel investment community. You're going to have, technology is allowing so many companies to access investors that they wouldn't have been able to before. And with the angel investors, you can reach out to people that have the experience, the success in your particular industry, for example, who may be more amenable to providing financing. So again, it is a tremendous benefit for innovation and entrepreneurship and economic growth and all those things that we want to see accelerate.
Mm-hmm. And Jamie, why don't you share some of your insights from your research on this?
Yeah, so I happen to think that financing innovative activity is one of the key pieces of that black box, really sorting out the connection between finance and growth. And the reason is because nobody argues that innovation isn't important. So if you ask for a list of things that matter for economic performance, people are going to say human capital, innovation, productivity growth. At the same time that innovation is so important for economic performance, it's also one of the most difficult activities to finance externally. So if your capital markets aren't working well, what kinds of activities are really going to take a hit? It's innovative activities. Why? Well, think about it. They're risky. Often there's not a lot of collateral value whenever we're talking about cutting-edge science, high-tech investment, research and development. It's hard for firms and entrepreneurs to really explain to outside lenders or suppliers of financing what they're up to. And can you really believe the entrepreneur whenever he or she tells you that they've got the next great thing? So all of the factors that make financing externally problematic really apply to innovation. And so if you want to pin down the most important mechanisms through which finance matters for long-run growth, I think innovation has to be at the top of the list. And indeed, some of the work that we've done, for example, looking at equity markets. So if you want to finance innovative activity, I think equity is particularly important. But looking at the development of equity markets and access to equity capital across countries, again, where does this matter? And the answer is this matters for R&D investment, innovative activity in high technology sectors, the sectors that are really pushing out the technological frontier. Now, this isn't where most of the economic activity in the U.S. is concentrated. Don't get me wrong. These aren't the kind of small firms maybe that you're studying, but they are the kinds of firms that really matter for driving our economic performance over the long run. And so we find a significant connection between how active your high-tech sector is in terms of investing in innovation and how robust your equity markets are, how much arm's length supply of financing there is. And I would add, certain types of firms in particular are sensitive to this financing. It's the younger startup companies that don't have the internal resources to make these investments on their own. They need the external capital.
And what about collateral? I think you mentioned that's a key.
Well, it's a key. I think it's important for understanding why equity markets are so important in particular. It's difficult. I think there's two pieces, two parts of the innovative activity that make credit not the preferred source of funding. One is a lack of collateral. It's not to say there's no collateral in innovative activity, but there's not as much as there is in, say, if you want to build a new factory. And the other is just the risk. So a lot of times these innovative investments aren't going to pay off. So you're going to have a lot of failures, and every now and then you have Google. Well, that kind of payoff structure it's not the kind of payoff that somebody making a loan likes to see, right? They want to see it and be able to be paid back. They don't participate in the upside when you're Google. So those two pieces together make the supply of risk equity capital in particular so important, I think, for that segment of the economy.
Let me just piggyback on that a little bit and say that I teach finance to undergraduates at Mississippi State University, and one way I try to talk to them about innovation and entrepreneurship is kind of like in the back-to-school model with Rodney Dangerfield. We form our own company, but it's their company that they came up with. So last semester, we had a duck hunting guide operation. Okay, this is our new business we were going to form. And so we'd have to figure out what kind of assets do we need for this business. Well, we need some boats, so we need a pickup truck. We need some shotguns, a couple of dogs, and we're in business.
Do you need a business partner?
Yeah, right. We had, we had 75 students that were all, we actually have a competition to see which idea emerges as the best one, and this duck hunting guide one was overwhelmingly the favorite. Imagine that in Mississippi. But anyway, but I would ask the students, the first question I'd ask is, okay, we need to get some money, right, to start this business. Where do we go? And the first thing what do you think the first thing they always said was? Banks, right. And I'd say, okay, we go to the bank. How much money have we made in our duck hunting operation? None. Okay. What do we project we're going to make? Well, we're not sure. Okay, so we have to tap equity markets, and we would hit investors, and I'd always pick somebody in the room to be the big, the Trump, I guess, of the investment, and put in $100,000, and somebody else puts in $20,000, and I'm in there for $1,000. But then we can do corporate governance things like who's going to vote and what have you. But that for them to separate in their minds that debt is not the first way to finance. You have to hit equity markets first, and because of the risk that equity holders are willing to try. Like you want to be a partner,
Yeah, though I mean, if I could piggyback off that and maybe push back or present a somewhat different view is, I love duck hunting. I would not invest in this company because where's my exit, right? I mean, there's the scalability question. So, and the research we did, we asked a bunch of small and medium-sized businesses, how do they access capital, how do they plan to access capital, and where are they looking for in a capital source? And debt, bank debt, followed by marketplace lending, followed by security-based debt, bond offerings, were the lead. And a lot of it is because these sort of Main Street businesses, they don't have an exit. There isn't a liquidity event that they can point to, or that their prospective investors can look at and say, well, that's where I make my 10x investment. That's where I get compensated for the risk. And so, the equity markets are essential, and nothing I say should diminish that, be taken as diminishing that. But we also need to look at the debt/credit markets, because while these high-tech, innovative companies do a disproportionate driving of growth, the bulk of jobs are in non-high-tech, quote-unquote Main Street companies. So, we need to make certain that the capital markets or the financial markets can satisfy both groups. And there are unique challenges there. And yes, the sort of chicken and egg of, well, I don't have any collateral, but give me a loan, is a problem. And we're seeing innovation in the space through, say, marketplace lenders, where they either are using different pricing models to try to come up with a better risk price and making loans to groups that banks wouldn't, or they're, some of them are utilizing things like personal guarantees. But they're getting that initial tranche of capital in.
That's, it's important to understand, right, where do all these things come from, especially at the startup level. And, I came across the most recent survey that Wells Fargo did for startups, and it's lines up with in the past. 82, I think it was 82. I wrote these numbers down. 82% came from personal savings. So you're starting up a company, 82% is coming. Now, number two was bank debt. Now that was kind of surprising until you crawl inside that, where you talked about personal assets, putting up your your mortgage, all those types of things. Then it fits. That makes sense. The one that sends a lot of people screaming from the theater is our credit card debt. But that's 31%, I think 31%. Friends and family, 30%. Those are the big places where, when you're starting up, that's where the money's going to come from. But think about those various parts we just mentioned there, right? Okay, personal savings, right? Well, the banking system, obviously, or financial institutions are involved there. But you're taking out a second mortgage on your house, whatever. You're using credit cards. All of those things come into the equation when you're talking about funding startups and small businesses.
Which gets to my earlier point about sort of the personal liability and the corporate form, is if we want people to be willing to start up new businesses, both high growth and Main Street, and I think we do for a host of social reasons, a well-functioning, vibrant, diverse financial system that can help shift that risk away from true personal risk is a real benefit, because people are going to be less likely to take a risk if they're having to put a second mortgage on their house or max out their credit cards at 30%. And to the extent that technology and regulation, or lack thereof, can coordinate and help people find their counterparty who wants to take on the risk easier, that's going to be a real benefit to society.
Thanks. We touched a little bit on this, but some academic research points to the fact that the financial system tends to benefit small firms, which in turn generate growth. So can you illustrate that in any other way, or touch on that? Yes.
Yeah, I mean, I think one way to think about what I think you're saying is that having a well-developed financial system is particularly important for the small firms, because they're the firms that would not otherwise be able to make the investments. But one distinction we have when we're sitting up here talking about the different mechanisms through which the financial system matters is, it's helpful to get on the same page about what exactly a small firm is. And I think that the kinds of small firms maybe that Brian's used to seeing in surveys, and the kinds of small firms maybe you're used to dealing with, the Main Street firms that you talk about, I mean, that's most of the firms. So if we just count up businesses, right, they're very small. And it's not clear to me, and you guys might have a better sense, this is the small town dentist, or maybe plumber or hardware store owner or something like that. I don't know. I don't have a good sense for how important capital constraints are to them. I see from the evidence that they raise a lot of debt. They get a lot of bank loans. I think the action, so to speak, when it comes to finance being a hindrance to performance is in the growth sector. It's in the small to medium-sized company that has a lot of room for expansion, but not yet a lot of internal funds that they can use to make investments. So I'm not sure the 2 or 3 person dentist shop is really where the action is when it comes to financing growth, but I may be wrong about that. So when I think about small firms, I think about, the very micro company just trying to get access to public equity. This company is vastly bigger in some ways than the Main Street shop. And so in that sense, that kind of small company disproportionately benefits from strong capital markets, strong angel financing, strong venture capital markets. They're much more innovative and they're much more active and they're a bigger part of the economy if we look across different kinds of financial systems when we have well-developed financial markets. So there's that sense in which it impacts small companies.
Yeah, the Gazelles, if you will, right?
Yeah.
That's what, those are the small firms that we hear about small businesses creating the bulk of jobs, new jobs, and that is true. But within that, you have the Gazelles, the ones that really just are those great potential growth companies that are just going to maybe revolutionize an industry and so on and create a tremendous amount of innovation, jobs, and eventually economic growth. So you're absolutely right. And you have to kind of break this all out into various segments, various industries, and then even within industries, what firms are going to be the Gazelles and what ones aren't. So there's a lot of moving parts here. But again, it all speaks to addressing both debt and equity when we're talking about this.
Right.
Absolutely.
Because the smaller, the Main Street businesses, they're having challenges too. I mean, community banks are dying. Banks are retrenching in their loans, and I think part of what we see there is that there is an entire emergence of marketplace lenders who target those firms, right? Small loan to small business. There's innovation is driven by need, and there's clearly a need for financing at that level as well. And it's not, I don't think there's anything sort of zero sum about this, right? We need to ensure that the financial system works from the Main Street dentist all the way up to Google, because they're all important. They all do different pro-social things, whether it's generating a lot of GDP or generating a lot of jobs in San Francisco or wherever, or if it's providing jobs for 3 people in a small town who otherwise wouldn't have jobs, right? I mean, it's all and doing dentist work. It's all important.
Yeah, not to say anything bad about dentists. Let me just follow up with one more. Sure. I think, don't you have some evidence on how much these companies say they need credit? How much they are seeking out access to credit? And
yeah, so what we saw is that a lot of businesses say they don't want to access debt, they want to self-fund. What we don't know, and what is a subject of should be a subject of future research, is to what extent is that they're scared and overly conservative and are leaving growth on the table, versus a choice of we are making an active choice to self-fund because we've hit the point in our revenues where we can, versus in a perfect world I should be seeking more growth capital, but I don't want to because either I think they'll turn me down, or I don't like the terms I'm going to get, or what we saw hangs up a lot of people is the process. Particularly with banks, that it's a long, relatively onerous process, and they still don't have confidence that at the end of the day they will get that loan.
I'd also be curious as to what those views were now or most recently, and then obviously pre our economic mess, and how that was viewed, and that would be very interesting. So, because that expectations issue comes in, especially I think with small businesses and how critical they are. Part of the reason that we've had a miserable recovery, one of the worst on record, is because I think of this tentativeness among small businesses, and then you can get into a whole host of numbers about levels of entrepreneurship falling off and the reasons for that. So there's a lot in the mix here that speaks to those those issues and questions.
So thanks for helping us understand how finance fosters growth. I'd like to now address some of the challenges in this process. And what do you see as hurdles that may be impeding finance from fostering growth, broadly speaking? I guess I'll start with you, Brian.
Sure. Well, so I mean, as was previously mentioned, there's the concerns that, I mean, there are concerns in terms of process, and some of that's driven by regulation, and some of that's driven by other factors, about whether or not sources of finance, whether it's the equity markets, the debt markets, banks or non-bank lenders, can provide access to capital profitably. And you hear anyway that banks, part of the reason why banks are retrenching from small business, like really small business loans, is that they can't do it profitably. The amount of due diligence and work that they have to do on a $50,000 loan is not that different from a $1 million loan, but now they can't make money on the $50,000 loan. And so we're seeing, like I said, this rise of marketplace lenders where their argument is we are much more efficient. We can use technology to do this more efficiently. And then on the equity side, or securities market side, there's an effort to expand access to securities markets for lower and lower size companies that's not a public offering. But there are regulatory challenges there in terms of making it cost effective and viable. And even in some cases, we're still waiting on the final regs.
Okay. Jane?
Yeah, I'll follow up on that because I study arm's length financing. So to me, how costly is it to access security markets? That's what's key. And as you suggest, I mean, relatively low cost access to security markets for small but growing enterprises, that seems to me to be far and away the biggest issue in terms of linking up finance with where it needs to be but may not be flowing.
Yes,
Right.
I mean, I agree, and including what the congressman said earlier today, that it really is, I think, the regulatory matters. I mean, and how they impact, in particular, smaller banks, and then therefore how they impact those effects stretch out to small businesses. Because when you look at loan approvals, and who was it, 50% of small business loans come from small community banks, and they have the highest rate of approval for small business loans. So when they hit rough regulatory waters, it's going to be felt by the entire small business community.
And wouldn't you say that compliance costs are higher with small business? I mean, and I would urge anybody who's like in the regulatory realm to just put yourself in a spot of if you're a small business, you don't have extra people to help fill out forms and do compliance and due diligence and what have you.
There is no legal department.
There is no legal department, that's right. And so I think the burden falls disproportionately on smaller businesses for regulation.
And I think, Brian, you also found some evidence on that as well, right?
Right. What we found drives small business preference for what type of funding they're going to access. I mean, cost is obviously a factor, but speed and certainty and the ability to actually and the terms and the process. I mean, the terms are the terms, but that the process not be onerous. That you can do this and get an answer, yes or no, relatively quickly without having to really distract yourself from running the business is a big part of what people want, what small business owners and medium-sized business owners want in a capital source. So, to the extent that regulation makes it hard for banks to do that, other entities, other non-banks are filling the void.
Mm-hmm. Do you think the challenges in the regulatory space come more at the federal level, or is it state in the markets that you cover, or both?
Yeah, both. I mean, and I think it depends kind of on what you're talking about, right? Because I mean, securities laws, there's a lot of federal law, there's a significant amount of federal preemption. So there, the hang-up, like Title III of the Jobs Act for crowdfunding, there's federal preemption there, right? So you don't need to worry so much about the state regulators. But the SEC hasn't gotten the reg out the door. Reg A plus, they preempted the states. The SEC preempted the states because they felt that was necessary to make this thing work. A couple of states are suing over that. On the banking side, there's much more state law involved and many more state regulators involved. So I think it really depends on the type of capital source you're talking about, but there are regulatory issues at both levels.
Yeah, I agree. Yep.
All right, I think, how about, given the fact that people in the media, academia, politicians question the issue of whether we have too much finance, if you're trying to convince the court of public opinion, who do you think is the most in want of hearing this message that finance fosters growth?
I would say it's employees and potential employees. I think that they have we may not realize it, but everyone has an interest in there being a robust employment system with many different companies vying for your labor, because then there will be more robust competition for your labor. You will have a better negotiating position. Life will be better. And I think frequently people talk about the finance system as if it's just something for big rich bankers or whatever. And people should be mindful of its impact way down the size scale, and think about what type of environment they want, what type of environment they're willing to tolerate risk for, to allow more small businesses to start. And of course, in the United States, every big business started as a small business, right? So you have to, you don't want the Gazelle to not make it out to run.
I guess it's okay if everybody hears it. So I guess my perspective would be those in most need of understanding, not just that finance matters for growth, but I think the mechanisms through which it matters. So what specifically are the laws, rules, and regulations that really matter and that really impact access to capital? So if we can inform that debate, if we can have some evidence on that, then I think clearly those who are in a position to change those rules and regulations are the ones that most need to hear about these mechanisms. So I guess that would be some of the people here today.
Yeah.
I think it's everyone that does not own a business or is involved in running a business, quite frankly. Because when you look at those polls, again, people love small businesses, people hate bankers. There's a complete disconnect here. So it's a challenge. I mean, in addition to being chief economist at the SBE Council, I've been a newspaper columnist for over 20 years. So that part of my work is to communicate these ideas in a way that, basically everybody can hopefully understand them. So this is a tremendous ongoing challenge. And I'll tell you, what I've resorted to lately when I speak to groups is, what? I think what's been a tremendous benefit has been a television show, Shark Tank. Mm-hmm. Because if I get people to watch that, because you get an idea there in a very tight, entertaining format of what it's like to, present an idea, present a business plan to investors. And those quick questions are very much what every business gets. Mm-hmm. It's like, what's your product, what's your service, and who are you? Who are the people running things? Those are the big questions. So just watching that show may be a great education for people to kind of start to understand how this process works.
And I would say I'd want to appeal to the 57% of the people in the Economist poll who said that, finance gets in the way or it hinders the economy. And I think what happens is we tend to look at the villains of Wall Street or whatever, and a few investment bankers, and forget that finance impacts us all greatly in home mortgages, auto loans, college educations, credit cards. You can take your credit card. You don't need cash anymore to go anywhere. You can go to the airport, take out a credit card, and next thing you know, you're wherever you want to be. And to think about how finance really impacts you personally, and what you do without it, I think is important. And I think the attention, of course, is on the financial crisis and the bankers and the boogeymen, so to speak. I just think that's a little bit unfair when you think about how finance really touches us all in just our personal lives. Investment for our 401ks and money management, risk transference through helping with reducing or keeping a constant profit margin so you can profit and plan. So that's who I would try to talk to, are those.
So thanks everyone to each of you for sharing your perspectives on the inside of the black box of finance and growth, and also the challenges that we face going forward. Please join me in thanking each of our